Hi, I'm Richard Jeffries from Newbridge Financial Services. Today we'd just like to speak to you about the instant asset write-off and what changes have been made there from the government. I have with me Tom Gray from Thomas Gray Chartered Accountants. Tom, thanks very much for joining us. Can you just give us a little bit of a summary of what's involved now with the instant asset write-off?
Sure. So the instant asset write-off is moving from $30,000 to $150,000, and this applies on a per asset basis. So businesses can write off a number of assets up to $150,000 in one financial year.
And Tom, just the eligibility and timing around that, would you mind just sharing that with us?
Yeah, sure. So instant asset write-off works on the aggregated turnover threshold of the businesses. That was 50 million. It has now moved to 500 million. And it's worth pointing out that it's critical that this applies to 30 June 2020, and it applies to new and used assets, but they need to be installed or first used prior to 30 June 2020.
Right. And any examples you might be able to share with us?
Yeah, sure. So the first example, I've got a construction company that has a turnover of $2 million in the 2020 financial year. John's the director of that company, and John is looking at purchasing a used piece of equipment worth $140,000 exclusive of GST. This piece of equipment, well, let's say it's going to be used, installed prior to 30 June 2020. And in this scenario, John's company would save at the company tax rate of 27.5%, $38,500 in tax in the 2020 financial year.
And Tom, another example that you might have?
Yeah, sure. The second example I have is Jane, who is a specialist doctor. She's trading as a sole trader, and she has a business turnover of $460,000. Jane is looking at purchasing a new piece of equipment worth $125,000, GST exclusive. So in this example, Jane's taxable income, we'll say for argument's sake, is $460,000 in 2020 financial year. Her tax at a marginal tax rate would be $189,297. Now, if Jane was to purchase this new piece of equipment, her taxable income would reduce by $125,000. So her new taxable income would be $335,000, and her tax on her new taxable income would be $130,547. So that's a tax saving to Jane of $58,750. And Richard, I just wanted to point out here that depreciation is claimable on the examples that I've given for these assets. This measure is effectively bringing tax into alignment with cash flow.
Right, yeah, it's quite a saving. And Tom, just any exclusions that might exist?
Yeah, great question. So I just thought I'd point out that there is a limit on motor vehicles. So the limit is $57,581 in the 2020 financial year on motor vehicles. So even if it costs more than that, the business portion is limited to that $57,581.
Sure. Okay. Well, we really hope that's been of value to you. If you'd like more information or would like to have a chat to Tom directly, you can visit his website at tgca.com.au, or if we can assist with any finance needs you have, our website is nbfs.com.au. Thank you.